Hi guys, and thanks for tuning in to the Ask Nugget Show. This is part 2 of our trading special. If you haven't seen part 1, I went through the different types of traders, and just like with part 1, part 2 I'm going to go over all the different indicators and techniques that traders use, but you can use 10 different indicators, you can use one, you can talk to 2 different traders and they'll swear by one and the other will tell you the other doesn't work. So you have to find a method and a technique that fits your personality, fits your trading style. As I say, I recommend having a basic understanding of them all to really help you rather than just learn one. So to start off with, the first one I'll mention is the RSI, the Relative Strength Index. Now that gives you a scope of how strong a coin or a chart has been relative to that time frame. So if you hear the saying overbought or oversold, it doesn't tell you a lot without knowing what time frame they're talking about. So if we say we're oversold on the weekly chart, that tells you that, you know, the relative strength over the past few weeks when we're comparing it, it's relatively weak. There's been a lot of selling. So as a general rule of thumb, that means that there's more likely to be more buying in the future, or, you know, it can't continue to be aggressively sold. It's very unlikely. Things tend to come back to the mean, if that makes sense, and average out. So if we go into the shorter time frames and something's just been completely going parabolic and you hear someone say, geez, that's overbought on the 5-minute time frame, it means it's highly unlikely to continue going higher at that rate, because relative to other 5-minute previous candlesticks and time frames that have taken place on that coin, it's the strongest it's ever been for that given time frame. So again, it doesn't mean that it can't go higher in another hour or two from now or tomorrow, but in the next few lots of 5 minutes, it's so relatively strong that chances say that it's going to pull back to the mean and cool off a little bit. So whatever you're looking at, whether that RSI is in the middle or high or low, it is relative to that time frame. And as I said, with all these indicators, they're just giving you little clues. Rarely would you trade on one indicator alone and say, oh, it's overbought or oversold, I'm just going to buy now, and follow it blindly. The next one to talk about is the MACD. So the moving averages convergence or divergence, and similar to the relative strength indicator, you'll see those lines, and I've done detailed breakdowns of these as well, guys, but as a basic introduction, it's telling you if the moving averages are accelerating away from each other. So on the shorter time frames, is this coin getting bought and accelerating at a higher price at an aggressive rate, or is the price action slowing down? So if it's slowing down and flattening, then the faster moving average will be catching up and converging with the slower moving average. Versus if something's taking off in price and going up exponentially, they're going to be diverging. The slower moving average is not going to be catching up to the shorter moving average, and that's what we see charts getting overextended to the upside, or, you know, oversold on the MACD to the downside. Means that something's sold off again so fast, it generally has room to slow down, or it can't keep up at that rate. And that's when you'll hear traders saying overbought or oversold on the MACD. And just like the RSI, it is relative to that time frame. So something can be overbought on the 5-minute chart, but oversold on a daily chart, on a longer time frame. And again, having that understanding that something might not go up in the next few lots of 5 minutes because it's overbought, but on the daily time frame it's oversold. So over the next few hours or days, it's very likely to probably go up. So having an understanding of those time frames is very important, guys. Next one to talk about is volume. Now, if a price moves from one point to another on large volume, that means a lot of trading took hands, how many coins got traded, versus if something drops on a small exchange with not a lot of volume, it might be one person that's moved the price down 50% just because there wasn't a lot of liquidity or orders on that order book. Now, does that really mean that that coin's worth 50% less because one person pressed the sell button? Or in the past, we've seen flash crashes down to 0 on one exchange because someone's flooded the order books with huge sell orders. Now, that volume on one exchange might have pushed the price down, but if we looked at the volume compared to all exchanges and that day, the 24-hour volume on CoinMarketCap, we say, well, that little volume over there, it's not really relative. It's the same when we see big moves up in price and then it might come back a little bit, but if we saw all the buyers coming in with huge volume and pushing up the price, and then when it cools off and has a little bit of a retracement, if it's very low on volume, that means that, well, out of all those people that bought, very few people actually sold. So we can get little clues from volume. Again, I'm trying to give you a brief introduction. I'll talk about this stuff in more detail if you really like, guys. The next one to talk about is trend lines, or support and resistance. So these tend to be just straight lines that people will draw on the charts. There's a group of traders that love trading trends and will look at support and resistance levels. So when something hits a support level and bounces, it doesn't mean it's magically happening. It can be a self-fulfilling prophecy. If Bitcoin has bottomed at 6,000 4 times, if it comes and tests it a 5th time, there's a lot of traders that have their orders sitting at that level, or bots, whatever it may be. So yes, it does become a self-fulfilling prophecy to some, in some regard. In other regards, it's round numbers. If Bitcoin goes to $10,000 and a lot of people happen to buy it around $1,000, that to them is, tenfold profit. So they set their orders at these round numbers. Humans tend to like round numbers. So again, drawing trend lines, it can give us an indication of, what the flows are, the ranges, and trends and so on, but they're not necessarily gospel. They're just giving us an idea of what other people may be looking at and what price is doing. People tend to be very visual and like to find patterns and so on. The next one is fib retracements, and similar to trend levels, again, this is just if something moves up and it only comes back a little bit, well, as I said before, it means that out of all the people that bought, not as many people sold, or not as many coins were sold. So that person is happy with what they were buying. It was not just a trader pushing it up and then pushing it back down like we may see in a pump and dump. It means that the buying was genuine. Or on the downside, if we have a big leg down and then only a little bounce, it means those people were genuinely selling and getting rid of it. And again, little clues and fib retracements, Fibonacci numbers in nature can give us little clues about how many people and what percentage, is giving back after a move in one direction or another. Again, Fibonacci retracements, I'd probably put more weight in those on longer time frames. So if someone's saying, oh, it's had a 50%, 50% tends to not actually be in one of the real Fibonacci numbers, but one of the numbers that a lot of people look at. In terms of any number, pick any number, but if it's had a Fibonacci pullback on a 1 minute time frame, I'm not really giving that a lot of importance. Or if something's going up to 20,000 and Bitcoin pulls back to 10,000 and people go, oh look, it's had a 50% retracement halfway, nice round number on a long time frame, that's when there'd be more people, and I would put more emphasis on that. So again, hopefully that's a good introduction to fib retracements. I've spoken a little bit about just general support and resistance and round psychological numbers, log numbers, multiples of 10 and all that sort of thing. Humans like those sort of numbers. Another one that I tend to like once we have clear direction is Elliott wave theory. So Elliott wave theory aims to give you a visual representation of human emotion. And the best example I can give is the strongest move that people look for in Elliott wave is a wave 3. So Elliott waves tend to move in one up and then 2 down, then a big 3 up, a little 4 down, then a big 5 to finish. And then we tend to have A, B, C corrections. So that's just a very basic introduction. But the psychology behind an Elliott wave is once people know the bottom's in and then we go up, and that's wave 1, and then we have a little pullback and then it starts to take off again. And everyone in Bitcoin in the current price action, for example, would go, wait, wow, the bottom's in. I was waiting for it to go lower and now we're confident the bottom's in. That's why we tend to have a huge moves when an Elliott wave chartists try to chart wave 3, because that tends to be that psychology of missing out, and everyone knows the bottom's in, there's not going to be a new low, and they rush in, and that's why traders try to trade those wave 3s in Elliott wave. Other ones that I look at, Bollinger Bands. Again, it's just giving you an idea of price action and volatility relative to that time frame that you're looking at. So if something's become very, very confined. It's not volatile. It tends to become more volatile in the future. So we look for a break either up or down. I don't put a lot of weight in that, but I just want to be looking at these indicators that other people are looking at in trading and so on. And just like moving averages, it can give you an idea of when something's getting overextended to the upside or downside. Candlesticks is a final one that I've done a very detailed video on. Certain candlesticks can tell you certain things about the trading action, again, on that relative time frame. A candle with a long wick on the bottom on a daily chart will tell you that, wow, all the price action that happened lower in that given day got bought. Buyers stepped in and bought that as a good price, and we traded higher. So when you see those candlesticks with big wicks on the bottom or the top, they're probably the ones that I put the most weight in, because we can see those as possible turning points. So again, watch that video if you want more information. But I hope that's a good introduction. There's plenty of free courses out there. As I said, I recommend the Chart Guys and Trader Cobb's course. If you want to join our trading and fundamentals group, we try and talk about all aspects from day trading, swing trading, to the fundamentals and human psychology and sentiment, because my belief is very much, if you can tie this all together, you can be a very successful trader over the long term. So I hope you've enjoyed that two-part special, guys. Let us know your Ask Nugget questions in the comments below. Have you enjoyed this video? What type of trader are you, and what's your favorite indicator? Let us know in the comments below. Smack that like button, subscribe if you haven't already, share these videos around, and thanks for tuning in, guys. Cheers.